Welcome back, folks. This is 3 at 3, the show in which we describe that unusual activity that has drawn us into a particular stock, whether it is a bullish purchase of a call or call spread, or a bearish purchase of a put or put spread. We care about both, and we only really care if they're bought. We don't really care if just options are sold because, again, it is not a leveraged bet if you sell it. You can only make what you collect in premium if indeed you sell an option, whether it's call or a put. But if you purchase an option, you can make that leveraged return that if somebody has great information that they want to act on, well, they want to make a leveraged return, and so do I. So let's take a look at this one. Beginning of June, first week in June, they came in buying DLO, that's D local. They came in buying these calls, August 15 calls. Well, the stock did trade higher from $10 to 11, then 12, then 13, then $15. And we got to roll several times. Well, today, the stock explodes, as you see there on your screen. That's the stock up 35% at $20.90, call it 21. Well, it actually went all the way up as high as $24.20 today. So it was up better than double nickel, 55% on the day. So any of these calls that you may have purchased or rolled from one expiration to the next would have been very tasty, as they say. And certainly we've appreciated the run here. Because these options expire in 2 days, we are now out, but I wanted to share that one with you. And there's Pete and John celebrating, as we like to do. And there's the various handles for Market Rebellion on TikTok, for Pete and John as well. Now let's talk about fresh meat. What are we seeing today that really inspires us? Well, this did. Pinterest. They were buying the at-the-money calls, the 25.50 calls. Can't get any more at the money than that, folks, with the stock trading at 25.50. They paid 27 cents for it. Well, these calls have already worked, and you have until Friday. So what I will caution you on is you only have 2 more days to be right further to the upside. So if you're somebody like me who has traded and then you take some profits, great. That's the way it makes sure you can stay at the tables longer. But my rule of thumb is if I pay 27 cents and they double, and let's say they're trading, 50 cents, 60 cents. In other words, I've doubled my money. I take off at least half. Since this is expiration week, I probably take off 2/3 to 75%. And if it pulls back, I immediately exit the rest. That's the way I trade. Again, I can't give you financial advice. I am not licensed to do that, but I can tell you what I do, and that is what I would do. Then let's take a look at Suncor. This is, of course, one of the larger energy companies in Canada. They, of course, are intimately involved in what's known as tar sands. Very dirty way to get energy out of the ground, and much more expensive than some of the other ways. Other than deep water drilling, this is the most expensive way of getting oil out of the ground. But it does work, and many people have made a lot of money betting on Suncor when energy prices are moving to the upside. Well, somebody bets that they will be moving to the upside again, but maybe over the next 4 months. And that's because December 34 calls were purchased with the stock below 32. So they paid $1.22 for these. I would still be the guy that says, I want to buy the at the money call and sell upside calls against it. The nice thing about this setup is the time decay is not hardly a factor at all. Time decay can be a factor with any trade, but when you're out 4 months into the future, it's really just a directional bet. Yeah, if the stock collapsed back down to 30 bucks, these could go back down towards $1 or so, $1.05, but they are not going to, vanish. Instead, this is one of those plays where I would put it on and wait and perhaps try to set it and forget it. Again, as Ron Popeil famously said, leave it, let it sit, let it mature. And then hopefully a month from now, if interest rates and if energy prices have cooperated, we're able to take a nice big fat profit at that time. But I don't need to sell calls against it immediately. Third and final trade is a stock that's very familiar to all of us, Amazon, one of the biggest companies in the world, AMZN. They were buying with the stock at $136 a share. They're buying 10,000. That's a million share equivalent of the 1st of September expiring 145 calls. So these are 2 weeks and 2 days into the future, folks, because the 1st of September will not be next Friday, because next Friday, it's the 16th today. So this Friday is the 18th. 7 days after that is still in the month of August. So this is that first trading day in September, Friday, the 1st of September, that these calls will expire. And somebody bought all the way up at the 145 strike. Do I buy that? Not. I buy the at the monies, and my intention is, as quickly as this thing rallies, if it rallies, would be to start selling upside calls against it. And that is because these are fast time decay, the opposite of what we just spoke of with a December timeframe. These are only 2 weeks and 2 days into the future. So the time decay is fierce in these options. You need to be aware of that. So before you chase in, make sure that you are well-versed in ways where you can cut your risk going forward. All right, that's going to do it for, whoops, no, that's an old one. Sorry about that. I don't know why these are on there. Guess I left them in by mistake. Sorry about that. So let me just recap then, since I screwed those slides up. Our first trade of the day today was Pinterest. The second trade was Suncor, SU, and the third was Amazon. Make sure you go to marketrebellion.com/get started to learn more about hedging, to learn about cutting your risk in long and short positions through the use of options. And we would welcome any of you to join our various subscription products, not just education, but subscription. Check it out at marketrebellion.com/get started. See you tomorrow.